Hey everybody, it is Wednesday, March 30th, reporting to you. I forgot to put this on. Anyway, you know the story. All right, gotta do this. Wednesday, what Wednesday? Monday, I'm fried. I am fried. Monday, March 30th, coming to you from the epicenter of the coronavirus pandemic in the United States, and that is New York City. We have over 45,000 cases in New York State, I believe, almost 50,000 cases, more than 30,000 cases here in New York City. So, I mean, I am just, at home like everybody else. By the way, I got this. I'm wearing this thing to ward off the evil spirits. It's bad here, folks. I can't even, it's almost like a surreal situation. They set up hospital tents in Central Park. Central Park, our main park here in Manhattan. It's like something apocalyptic. It's like out of some kind of a crazy zombie apocalypse movie. We had the U.S. Navy ship Comfort arrive here in New York City with 1,000 beds. Everybody knows what's going on. This is an economic, a market program channel, so let's talk about that. It's hard because it's very stressful and it's on your mind all the time. And people are dying at a rate of one every 15 minutes or 17 minutes. You may have seen there was a video that I saw today online somebody took that video on their phone in Brooklyn of outside of a hospital. They were loading dead bodies onto a refrigerated truck. Picking the bodies up with a forklift and loading them onto a refrigerated truck. So it's, obviously it's very hard to stay focused on the markets at this time with everything going on. This is just an unbelievable situation. Now, let's talk about what's going on. You may recall, first of all, we've been long playing this bounce. And it almost seems like ridiculous to talk about playing a bounce when, the Fed's saying we could have up to 45 million, 47 million unemployed people. We all know the economic devastation that is hitting or is going to hit right now. That's obvious. But I made a video last week where I talked about the market as a discounting mechanism, where I said, the market reflects investor expectations, the market reflects forecasts. It's not always right. We've seen plenty of times market bubbles, euphoria. What was the term that Greenspan used? Irrational exuberance. We've also seen plenty of times of extreme panic and pessimism. If you've been with me for any length of time, I've been through all of these with a lot of you. They're very recent stuff. So this idea, this notion, some people say, the market always leads. It doesn't always lead. The economy leads. Basic economic conditions determine where the market goes. And very frequently, the market will overshoot. Why will it overshoot? Because what is the market? It is a collection of everybody together and their expectations and their outlooks and their beliefs, etc. And I think now is one of the times, and I said this last week, where the crash in this market, which in some ways has exceeded the 1929 stock market crash. In my opinion, I think it has already reflects, or it has discounted the economic toll right now that we are about to feel, at least for the next few months. Now, I said new variables have entered the picture. And these new variables are basically, the new variable is this fiscal package that was just passed. And although I think this fiscal package is, big time inadequate, it's something right now. All right, I don't like the loan aspect of it. I don't like the meager sum, the one-time $1,200 to people, stuff like that. Now, there are some good things in there: the extension of unemployment benefits, the increase in unemployment benefit pay. There was a concern about people having to wait a long time. The government's setting up a website where you could put in your bank transfer info. So, that's going to help. Again, you have to consider the new variables. And the new variable is the fiscal package, which I think, at least now, in the very near term, is something that we have to consider. So the market, at least as far as my belief, has discounted what we expect to see as the negative effect right now. Remember, market crash, in many ways bigger than 1929. New variable enters the picture. We have the fiscal package coming into the picture. Money's going to be distributed. Also, and by the way, today's Monday, just so I mentioned, I sent out the new report, MMT Trader. So if you want to get that, go to my website, sign up for a free trial, 30-day free trial. I put the link, as I always do, right in the description down below. So you can just click on that link and get the 30-day free trial. The banking data was, it was shocking. Shocking. I went over some of that, I think in the video I made on Friday. The increases in bank credit, in loans and leases, in commercial and industrial loans, in bank assets, in bank deposits. In many of these metrics, they were the biggest 1 week increases ever of all time. You had increases in 1 week. Deposits, for example, up over 300 billion. You had bank assets up almost 500 billion in a week. These are like crazy, crazy numbers. So one of the things it tells me is that, especially with, if you look at loans and leases, the commercial and industrial loans up 180 billion. And now these things the commercial and industrial loans were contracting. You go back to some of my videos like a month or two ago, and I was talking about how, look, these loans are falling off a cliff. And suddenly, boom, what a turn. They were at a growth rate of practically zero year over year. And then they just jumped up in the last week. The increase was so enormous. It was so gigantic that the increase jumped from like 0% year over year to 9% year over year in 1 week. So what does that say? It means corporations have quickly run to the banks and either tapped credit lines or got new loans. They're flush with cash right now. So I think, at least this month in April, where there's a real concern about who's going to be able to meet payments, who's going to be able to meet their obligations, things may be all right. Everybody tapped into credit lines. What wasn't so strong were in the consumer area. But even that, the decline was very, very modest. You have to have your finger on this stuff. It's easy. Look, I don't have to tell you. You look at the headlines, it is dire, it is horrible, it is frightening. Anyone would want to sell the stock market at this point. Anyone. There doesn't see, even when I tell you right now that I think, hey, it looks like maybe we're going to get it. Even me saying it, I feel sometimes silly in even saying it. But you have to stay focused. If you're going to be a trader, first of all, I'm here in New York City. I'm trying not to get sick. That's the last thing I need, obviously. It is getting, at first I was kind of like, don't worry, I'm a tough guy, I'm a strong guy, I got a good immune. But now, really. But what are we doing here? We're involved in the markets. Okay? We're involved in the markets. We're traders. We're investors. I have to stay focused. I have to stay focused for myself. I have to stay focused for you guys. It's not easy. So this is the picture I have put together. Now there's other things going on too. There's very important developments in oil. Very important developments in gold. The Russians stopped buying. The Russians have stopped buying gold, and they were the biggest gold buyers over the last 2-3 years. This is not good. Not good. Anyway, it's all in the report as usual. Where are you guys? Go get the report. And by the way, you never stop learning. I have people saying, well, you know, I understand it now. I don't have to, you know, like, I could go off on my own. No, it's a constant process. Constant learning. That's how you elevate yourself. That's how you raise your level. Never stop educating yourself. Never stop trying to become more informed. Even me doing this thing every week, learn something new. Go to the website. It's in the description below. Sign up. Stay well, everybody.